Hi, everyone. Ben Driggs here, Navigate Financial. It is July 1st, and I thought it would be good to create a video of the the quarterly market review and market outlook that we've done for many years, but we've always done that in written form. So for those of you who would prefer a video broadcast, I thought I'd just spend a few minutes and talk about what's going on in the market, what's been going on this year, and what we see is happening here over the next several months. So just as a review, what's been going on, the markets year to date are actually, at the end of the day, they're doing a little better than average. Just a moderate portfolio is up about 6% year to date. On a long-term basis, you'd expect about 6%. So we're tracking twice, we're doing twice as well as we are ordinarily doing at this time of the year. So we're pleased with the overall returns of the stock market generally. And so we'll go through each of the different areas of the market really briefly. So let's talk about U.S. stocks. U.S. stocks are up maybe 4 or 5%. International stocks are up much better, maybe 15-ish or something, a nice 10% spread there on the international side. I think that that's going to continue, and we'll talk briefly about why that might be happening. On the bond side, bonds are up maybe 3-4% or so. That's kind of tracking about what we would expect. And for cash, the third category, cash rates are still hovering about 4% year on an annual basis for your kind of high yield money market. And so halfway through the year, you would expect to be getting about 2%. So maybe 2% in cash, 4% in bonds, 6% in stocks, 6 or 7% in stocks, depending on how much international exposure. And that's really how the markets are playing out. So the big story for this year happened in April when Trump announced the tariffs would be more aggressive. That was starting to simmer in March. And for the last few weeks of March, the stock market went down, bond market went up. There were concerns that there was trouble ahead with these tariffs. And then beginning of April, that really intensified. For those of you who paid attention to that, markets dropped very, very sharply in the couple of weeks of April, and then Trump backed off, and people started to relax more, started to get more accustomed to what the tariffs might look like, and then they bounced back even stronger than before. So there's been a very strong run particularly in U.S. stocks over the last couple of months, ending the quarter, which was yesterday, the end of the second quarter, ending at record highs. So stocks are having a good year so far. So let's talk about what we think for the next half of the year. It's kind of a mixed thing. There's still a lot of momentum in the markets right now, but I think there's growing concern that we're getting ahead of ourselves. I think stock prices are a little elevated right now, particularly in the United States. So I'm generally recommending people certainly don't buy any more stocks. I don't think it's a time to be aggressive, and perhaps shift a little more to international stocks. There are a few reasons why international stocks are doing better than U.S. stocks. One of those is price valuations are more attractive. So people are shifting to more, they're taking from the U.S. stocks, which have outperformed for a long time, moving those over to the international markets. There is a feeling with Trump that he's putting a lot of pressure on Europe to step up, say with NATO and whatnot. And so interestingly, that is translating to more investment capital in European countries, that's bullish for their stocks. So money's flowing over to Europe in particular. There's also concern, not major, but statistically noticeable concern about the U.S. as being a safe haven as much as it has been in the past. So there is some shifting away from the United States for credibility risk. I don't think that's a big deal, but I do think that that's worth noting. So there are a few things we have because the concern about the United States being maybe not as reliable as it has been in the past. This is making the cost for our debt is staying high, and the bond rates, yields are high. There's still pressure on the bond market in the United States, and this also puts pressure on the dollar. And so when the dollar is weak, which we're seeing over the last few months, that is good for international stocks. So there are several reasons why international stocks should be doing well. Another big story this year is gold. Gold has done very well this year. Dollar has been weak. There's concern about instability within the global financial system. These things help an asset class like gold. So gold, international stocks have been the winner. Small cap stocks have been a disappointment, because coming into the year, there was a thinking, hey, we're going to be lowering interest rates as the year progresses, but that hasn't happened at all. Interest rates have remained elevated. And so at the beginning of the year, small cap stocks usually do well when interest rates start to soften and there's less pressure, but the economy is still hanging in there, which we thought was the case at the beginning of the year. Yes, the economy is hanging in there, but interest rates have still stayed high. So this favors large companies over small company stocks. So looking ahead for the next few months, I think it's time to be cautious. I would not make any major moves. If there's time to be taking money off the table, if you need some cash or you want to diversify, I think now's a good time to take money off the table if you wanted to do so. But as I mentioned in my typed up email that we'll be sending out here today or tomorrow, it's really kind of a tricky thing to be selling when we think things are high, because just when we think things are high, that doesn't mean they couldn't go higher. At any given moment, the market is trying to, price things as accurately as possible. And historically, it's doesn't play out well to be making big moves just because we think things are a little overvalued or undervalued. It's appropriate to make little tweaks along the way. And we're doing that with our clients, and also indirectly, the money managers and the people we're hiring within portfolios are also doing that as well. So everybody's trying to figure this out. The economy remains relatively strong. The risk of recession is still muted. I don't think we're headed for a major recession between now and the end of the year, but there's clear indications that things are softening. Interest rates being high for such a long time is starting to take its toll. We don't know about the tariffs right now. People are like, oh, tariffs, that was scary in April, but no big deal. But I think that's a little naive, because it's going to take many months for the effect of the tariffs to really hit consumers and companies. And so on the company side, someone's got to pay for these tariffs. Either the companies pay for it, they absorb the cost, that's going to decrease their profitability, or the consumers, they're going to pass it on to the consumers. Well, that's going to hurt consumers both from an inflation and a purchasing power standpoint. So in summary, I think it's good time to be cautious, good time to hold pat. I wouldn't be eager to be aggressive. I don't think we need to run for the hills or anything, but stay the course. Long term, we always want to be thinking on the long term for almost everybody. If you have a shorter term horizon, give us a call. We can talk about that. Certainly anything short term that you need the money within the next year or two, we want to be probably in cash, even over bonds. Well, there you have it. Ben Driggs signing off. We'll see you in 3 months, and hopefully there's a positive reception about our new idea of hosting this in video format as well as written format. Take care.